Hi there, this is the second video of chapter 10, and we're going to study depreciation methods. Okay, in this level, we study 3 different types of methods for depreciation. The first one is called straight line method, often written as SL, straight line method. The second one is going to be, maybe I should write that also. And the second is double declining balance or declining balance method. Often called written as DDB. And the third is units of activity method. Okay, that said, let's have a look at the straight line method. We will use the same case over the 3 methods so that we can compare one by one. Okay, the setting is like this. This is from your textbook, so you can have a look at it after watching this video if you want. Barb's Florist company buys a truck paying $13,000, and the company expects to use the truck over the next 5 years and sell the truck at $1,000 at the end of the 5th year. And then over 5 years, the issue is how much should we depreciate? We bought it at $13,000. So at the beginning, at the purchase, its value was $13,000. But at the end of the day, we expect that there will be the value left $1,000. Therefore, the difference between these two, which is 13,000 minus 1,000, which is 12,000, is the amount that we want to depreciate over the 5 years. That is, straight line method states that we depreciate over the useful life. How many years? 5 years. Equal amount. Straight line. Okay. Year 1, year 2, and the like. Our depreciation expense. How do you change the line in Excel? Alt, Enter. Okay. Our depreciation expense, we want it to be the same, straight line. Okay. What does that mean? We want to depreciate 12,000. Over the 5 years, the same amount. What do you do then? Divide by 5. Which is actually the same as 1 over 5, right? Multiplying 1 over 5, which is the same, okay. Which is actually the same as multiplying 20%, right? 1 over 5 is 20%, or 0.2. Right? We want to depreciate an equal amount over the useful life, okay? In such a case, how much is going to be at the end of the year our accumulated depreciation? Our accumulated depreciation is accumulation of the expenses, right? This one, our current year's depreciation plus the beginning value. In year 1's case, beginning value is nothing. So it is 0 plus 2,400. Next here, you copy and paste. What did I press? Control D. you accumulate the current year's expense to the previous ending accumulated depreciation. Okay? You do the same thing over the years. So that at the end of the year, at the end of its useful life, the ending balance is gonna be the same as ending balance of the accumulated depreciation is the same as the difference between these two. So that the book value of the asset drop. At the end of a period, at the end of a year. Book value meaning its net value of the drop after the depreciation. That's what I say here as the book value. The book value is gonna be at the purchase it was 13,000, but you've depreciated from 13,000. So far, at the end of the first year, 2,400. As a result, your book value of the drop, again, historical acquisition cost, which is 13,000, minus the accumulated depreciation is now 10,600. Right? You do the copy and paste or Control D. Again, here from the book historical acquisition cost, you take out all of the accumulated depreciation. You take out the depreciation that has been accumulated so far, which is 48,000. And it is 8,200 and the like. So that at the end of the 5th year, you have only 1,000 left, which is as expected. Okay. Then in this case, what are our journal entries? They are like we've studied this in chapter 2, but we are just recapping what we've studied. Of year 1, the item depreciation expense, how much is it? Here it is, right? And then you credit accumulated depreciation. How much is it? The same amount. Right? You do the same thing again and again and again over the next 5 years. Year 2, year 3, 4, and 5, right? But I wanna talk with you about partial balance sheet also. Under the partial in your balance sheet, you report something like this: truck or equipment gross, which is the acquisition cost of it. How much is it? By the way, the date is as of year 1. Your gross equipment value is, the same, 13,000, right? But now, how much did you depreciate? Accumulated. Right? Your accumulated depreciation so far is this amount. So that your equipment net becomes this minus that. Right? So I'm making single counting on the line, and here double accounting on the line, right? This is what you do as of the first year end. And in your second year end, what you do is, again, your equipment gross does not change. But now at the end of the second year, your accumulated depreciation is now going to be, at the end of the second year, you've accumulated how much? 4,800, right? So your equipment net value is going to be the same as this value, right? Again, at the end of the first year, the value is here. At the end of the second year, the value is here, right? So what's happening here? On your T account, okay, drawing a T account in an Excel spreadsheet is the one that I really don't like, but okay, I'll try. Okay, this is sort of confusing. I'm gonna fill everything white. Okay, so here, let's title accumulated depreciation. And then we can say that at the end of year one, we've accumulated the depreciation. How much? Here it is, right? At the end of year two, how much do we depreciate? Once more, the same amount, right? You're gonna do the same thing again and again, right? Accumulating the same amount under the what? Under the straight line method, so that at the end of the year, at the end of its fifth year useful life, you depreciate in total $12,000, which is the same as this one, right? Okay, this is the straight line method. I think maybe it would be good to cut the video here and then move on to the double declining balance method. Discuss it in the next video. Okay, then see you there.